Hello everyone, and welcome to this Keeping Your World Open Masterclass. In an economic environment characterized by greater uncertainty, greater volatility, and increased pressure on cash flow, one question keeps cropping up among financial executives. How can we continue to grow and keep our world open without exposing our business to risks that are difficult to control? How can we make better decisions? How can we protect our cash flow? Today we're offering a deliberately simple and straightforward format. Time to debunk the most common misconceptions surrounding customer risk management and credit insurance. And above all, to give you practical insight you can apply immediately in your day-to-day role. I'm joined today by someone who asks exactly the questions you'd be asking. Let me introduce you. This is Emma Laurent. She runs a growing business and works with clients across borders. As her company expands, she's increasingly concerned about how to protect her cash flow and manage customer risk. Trade credit insurance sounds like a solution, but she has questions, doubts, and needs clarity before making a decision.
Thanks for having me. I'll be honest. I've always had reservations about trade credit insurance. I've heard the arguments, but I've never been fully convinced. So, I'm here to ask the questions I've never had a satisfying answer to.
That's exactly why we're here. The aim is to start with the realities you face every day. Late payments, unpaid debts, losing a supplier, trusting a new client, or exploring a new market or country. We'll help you avoid the most common myths that lead to poor decisions, arming you with a real commercial risk strategy and actionable insights. Whether you already have some knowledge of risk management or have never dealt with the subject before, this interview is designed to provide you with a quick and easy overview.
Good, because there's a lot I'm skeptical about. Let's start with the big one. I've always avoided trade credit insurance because it seems like an additional cost in an already tight environment. When I look at the premium in isolation, I just can't justify it.
That's the most common place to start. And it's understandable. But this reasoning overlooks one essential thing: the real cost of unhedged risk. One single unpaid invoice can cost far more than the cost of cover, and it hits when you least expect it. Not to mention the time, legal costs, internal resources, and the impact on your balance sheet. When you compare credit insurance to the total cost of an unpaid invoice, not just to a percentage of turnover, the logic changes radically. The right question isn't, how much does it cost? It's, how much does an unexpected bad debt cost me?
I'd worry that it adds friction, that we'd be more cautious about who we talk to and sell to. That doesn't sound like a growth strategy.
It does the opposite. It helps you identify the right companies to sell to, so you can go after more business. With confidence, not hope. You're not selling less, you're selling smarter. Companies that structure their approach to risk are often the ones that grow most sustainably, because they know where they can accelerate and where it's better to adjust. Risk becomes a lever for commercial prioritization, not a brake.
Doesn't all this credit risk management just create more admin and slow everything down?
Good risk management actually speeds up decision-making, and not only for finance teams, but for the entire organization, including all entities if you are a global company. With the right connectivity tools in place, you're not deliberating over every deal. You have the insight to move quickly and grow securely. Decisions that used to take days can be made with confidence in minutes. The admin concern is real if the tools are poor, but with the right setup, it's the opposite of what you'd expect.
We've worked with most of our customers for years, Published balance sheets, historical relationships, sector reputation. Surely that's enough?
This is undoubtedly the most human of myths. Business relationships last for years. Weak signals seem non-existent. The accounts appear sound. Yet, experience shows that difficulties rarely arise where one expects them. Even buyers who've always paid on time can change overnight. A change of ownership, a market shift, a bad quarter. Situations change rapidly. Pressure on margins, cash flow strains, hidden supplier dependencies. Knowing your customers does not mean anticipating every risk. Questa puts risk insight in one place, analysed by expert colleagues, so you can act with confidence rather than assumption. Informed by continuous independent analysis, international data, and real feedback from the field.
I've heard that the only true value is if someone actually defaults, which hopefully never happens, so most of the time you're paying for nothing.
That's the most widespread misconception, and it's a very simplistic view of the role of risk management. In reality, the primary benefit is often invisible. Trust. Trust to underpin your commercial decisions. Trust with your financial partners. Trust to commit to volumes or explore new markets. It also strengthens trust with your bank, your suppliers, your partners, signaling strong risk management and translating into better financial terms. Not just a backstop when things go wrong. In many cases, credit insurance acts more as a growing management tool than a compensation mechanism. The real benefit emerges well before a default occurs.
We've always just set aside reserves. We have a good grasp of our loss history. Isn't self-insurance more cost-effective if you're disciplined about it?
Self-insurance works until it doesn't. A major default, a strategic client, a sector-wide domino effect, a macroeconomic shock can instantly exceed the reserves set aside. A single large exposure can wipe out years of reserves in one hit. Added to this is a reality that's often underestimated. Managing client risk alone requires time, tools, and a capacity for continuous analysis that few organizations can sustain in the long term. Self-insurance doesn't eliminate risk, it concentrates it.
So it's really just a claims product, reactive, not proactive.
Not at all. It reassures your business partners and can support better financial terms. When issues do happen, Questa supports the collections process, so you're not drowning in paperwork on top of everything else. But the proactive value is where the real difference lies. You're making better decisions before anything goes wrong, with better information, earlier signals, and the confidence to act rather than hesitate.
We do a lot of credit checking ourselves. Do we really need another layer of information?
The difference is in the quality and timeliness of the signals. Standard credit checks give you a snapshot, typically from 6 months ago. Questa business information pulls richer, real-time data, the kind that lets you negotiate payment terms with genuine confidence, not just work from a picture of how a buyer looked last year. With stronger insights, you can move faster, with more certainty. That's a commercial advantage, not just a risk management one.
Honestly, I still wonder, is trade credit insurance really for a business like ours? We're well run, we're careful, we're not operating in particularly high-risk markets.
If you sell on invoice terms, you're exposed. Full stop. Sector, size, and geography don't change that fundamental exposure. They only change the shape of it. With Questa, it's all in one place. Information, protection, and support. So you can grow without letting non-payment decide your next move. That's not just relevant for businesses in difficult markets. It's relevant for every business that wants to grow with confidence.
I came in fairly skeptical, if I'm honest, but some of this I genuinely hadn't considered. Particularly the point about self-insurance and what real-time buyer intelligence actually means in practice.
To conclude, let's take away 3 key ideas. Firstly, customer risk always exists. The difference lies in the ability to anticipate it and turn it into an opportunity. Secondly, the myths surrounding credit insurance often mask very real costs and risks. Costs that are, in most cases, far greater than those of a credit insurance policy. Thirdly, a structured approach to risk enables faster decision-making with greater confidence. If this conversation has helped you challenge your own assumptions, then it has served its purpose. If you'd like to take things further, there are several options available to you. You can download our guide, request a callback to discuss your specific situation, or simply take the time for an exploratory discussion with our teams. Because progress still belongs to those who move forward, to the businesses that keep looking outward, adapting faster, reaching further. To those who see risk not as a reason to stop, but as something to anticipate, understand, and overcome. And that's where Questa comes in. When the world feels uncertain, we keep yours open. Thank you for your time and see you soon.